Ladies and gentlemen, boys and girls, J-Stimp4, Realist News here. Haven't heard from this guy in quite a while, but I am glad that he has something to say, because he was a key element in blowing the whistle on the rigged silver market, specifically the JP Morgan traders. This man's name is Andrew Maguire. He was the one that contacted the CFTC, the regulator of the COMEX, to tell them, I know specific dates and times that the JP Morgan traders are going to knock silver down. And I'm going to email you the first time it's going to happen. So here it is. Sure enough, it happened. The next time he says, I'd like to be on the phone with you and tell you live when they're going to do it. Okay, calls the guy. Boom. Happens again. So that's two in a row. Happened the same exact way, same exact time he said it would. And what did we find? Nothing to see here. CFTC, we found no wrongdoing, etc. But he's got something interesting to say. I was over at silverdoctors.com because I was thinking recently, sometimes I buy it from JM Bullion. Sometimes I buy from Silver Doctors. And for whatever reason, I look at Silver Doctors for news as well, checking out some articles that they've got. And this is one that TF Metals report, which is from Andrew Maguire. That's where they got it from. But the reason I was on the site today specifically is I bought a few more Eagles. I'm trying to just keep, again, I know I mentioned I have my goal set. I've set another goal with as far as, purchases or whatever of my silver or whatever. I gotta get this little thing started. Anyways, so I'm bouncing around. Oh, Silver Eagle. I got a pretty good price on Silver Eagles right now. $229 SD bullion, $229 over spot, any amount. Man, how do you say no to that? So went and bought a few. And again, I'm trying to, even though I met my goal every month, let's just add a little bit more to it. Keep adding a little bit more to it. Add a little bit more to it. The more you add to your stash, the less silver price has to go as far as where we think it's going to go, hundreds of dollars. But if you can acquire a certain amount and you're saying, well, I'd like to own a house with silver one day. I'll just give you an example. I'm expecting a $300 or $200 an ounce silver price. And, I've got 1,000 ounces, let's say. 1,000 ounces times $200. You got $200,000. That's the house you want to buy. But the more you keep stacking, the more that $200 an ounce projection could come down. Because if you can acquire 2,000 ounces of silver, you only need a $100 ounce to get your same 200,000. Follow me? But having said that, what if it goes back to $200 or goes to $200 and you got 2,000 ounces? You follow me? Or 3,000, whatever it is. I firmly believe, again, and I've never wavered from this, metals prices will go insane at some point. At some point. And I don't think we have a whole lot of time, like we've been waiting all these years, hoping, and finally, okay, is there anything? Nope, not yet. Anything? Nope, not yet. I think we're really, really nearing that catalyst, that point, where we're going to finally see metals go, whoa, hey, I didn't see that. Oh, get you excited again. And then once that happens, I think it'll be game over because everybody else is going to say, I want in on that. We will have already been in on that. Everyone else is going to be getting in on that, which will be also causing the prices to go crazy because a bubble will be created. I'll say it again. A bubble in metals prices will be created. The key is for you to get out at the right time. And depending how much silver you have or gold, and depending on the prices, you may say, oh, I'm out at $200 silver. I'm out at $80 silver. Oh, I'm out at $300 silver. Whatever. So, when this guy speaks, I really like to listen. The Heightened Risk of a Gold Price Reset by Andrew Maguire. On February 6th, I warned of a heightened risk of a gold price reset based upon evidence that the all-important physical markets are increasingly influencing the price-setting synthetic markets at a time we are experiencing extremely strong physical demand into tight, immediately deliverable supplies. Speaking of which, I was just watching the X22 report on YouTube, and I'm not sure exactly how reliable this particular thing is he said, because I haven't found it anywhere else. But he said the gold bars that we gave back to Germany, which I discussed the other day, remember it was 2013, and we're gonna give you 50 tons back, Germany, a year, and then the first year we only gave them 5 tons, and then we halted it. Nah, never mind. All of a sudden, and that was to last till 2020. All of a sudden, they've got all their gold back as of now. As of this year, they got it back very recently. Whoa, where did all that come from? X22 report says there was a little issue, though, with the gold they received. They logged each and every bar that they sent over to the Fed to, safe house it for them. When they got it back, wasn't the same bars. The numbers don't match, etc. The labels, as they call it, were completely different. Again, I can't vouch for this yet because I haven't found it anywhere else. X22 report says that's what happened. So if that's the case, that explains why they never would allow any audits to take place from any other country, including Germany, who wanted to see their gold at one point. Nope, can't let you over here. Can't see it. But it's ours. We gave it to you. We know which ones we gave you. We'll just be in and out in a second. No. Can't come see it. That's because it was long gone. And now they had to get some gold to give back to them, and it's not the original gold because that's long gone. Follow me? So, he says, I've been drawing attention to the increasing outflows of liquidity from the paper markets into the physical markets for over a year now. The last sell-off from 1380, talking about the gold price, in July to 1130 in December provided clear footprints of a disconnect between the two markets and bears all the hallmarks that the rigged decline broke the back of the paper market. By December 2016, an abyss had appeared between these two distinctly different markets, very visible to wholesale market liquidity providers and takers, but also verifiable by the corresponding reported data. The co-basis, backwardations, GOFO, OPEX pricing and structure, SGE premiums as high as $46 an ounce, backed up what I was reporting from a wholesale market perspective, which is why we knew with certainty that gold would not settle below 1130, almost $100 above the target of 1045 that almost all analysts were touting. In fact, during the entire sell-off from 1380, at no time had fair value dropped below 1300. He says more on the fair value later. Synthetic players are disconnected from the delivery markets and, as a result, are blinkered to all important real supply demand inputs. However, officials and agents, COTs, driving the directional high-frequency trades, exposed to the physical markets clearly are. Consequently, despite bearish sentiment and momentum having ignited and fueled a major sell-off, capitulations and sucked in speculative short selling, gold bounced exactly at the physical support level, not the synthetic market target. 1130 physical support was well above the COT/central planners sweet spot, and despite evidence they were taking the long side of spec selling after expending large short fuel anticipating a much deeper discount, the residual short COT/official open interest lines did not cross equitably at 1130. Even worse, the support rose from there. This left sizable naked short COMEX open interest, or open interest is simply the contracts, and related derivative positions locked out of futures short cover, but worse, leaving COTs significantly offside on billions of dollars worth of bearish derivatives bets. Furthermore, recognizing CB and sovereign support at 1130, COTs were forced in front run these physical orders to ensure they wouldn't fill. Given these front run CB sovereign limit orders were largely unfilled, we have since witnessed an uncharacteristic chasing of price by these buyers. Historically, sovereign entities and well-informed CB buyers were afforded the luxury being able to read synthetic data and relying on fractional deliveries versus open interest, were able to wait for the synthetic non-delivery market to bring price to them. With the physical dog now heavily influencing the paper market tail, this is no longer the case. Each subsequent stair-step, 1176, 1204, and 1222, has further locked out commercial short cover. On Friday, although not yet of sufficient size to call solid support yet, the threat of 1232 and 30 cents becoming support started to materialize. So close to the FIBO inflection point at 1250 and 60 cents, such a stair-step rise in physical support poses a serious threat that threatens a commercial signal failure. Again, commercials are the huge players on the market. As noted on Friday in my opening post, quote, there is always a danger that COTs can short with impunity when the synthetic price gap's too far above the stair-step support levels. However, with support so close under the market and steady physical accumulations noted yesterday at 1240 off Loco London, COTs have to be careful in shorting into such tight conditions. With tightening spreads and a rising co-basis implies that only limited short cover is available. Footprints provide more evidence of an increasingly driven physically market forcing some discipline upon COTs who, although offside on OPEX positions, are forced to deliver physical. End quote. To those who are concerned that historical patterns will repeat themselves, there is an unprecedented difference between the December 2016 1130 bottom and the December 2015 1045 bottom. This time, the physical market had gained sufficient traction to limit the scope of directional high-frequency trade behavior. Why? Because the paper price set in London is ultimately deliverable both on and off Loco London. Dips inspire under the radar over-the-counter or OTC spot index buying, which members know, lock in the price, and when presented for delivery, force COTs to go to market and buy gold to meet delivery. These the BOE or Bank of England flywheels daily shortfalls, but then lays the liability onto the BBs who have gold bank account facilities with the Bank of England. Note the German repatriation had to wait almost 3 years for the Fed to be able to buy gold at market to repay loaned out physical bars. So again, what did I say right before I started reading this? Germany gave the gold to the Fed to store, safekeeping, as if Germany doesn't have its own, secure vault somewhere, whatever. Gave it to the Fed, and it is gone. It was always gone. They got rid of it as fast as they possibly could. They needed to put some fires out, so to speak. And now we want our gold back. So as he said, they had to go on the market and get it. Why didn't you give them back the old gold? If I have this Panda coin that I show a million times, and I hand it to you with the understanding that it doesn't matter that this is precious metal. It could be a piece of plastic. Matter of fact, it's inside of a piece of plastic. Your job that I'm paying you for each and every month, every single year, high dollar security fee for you to store this baby and guard it with your life. Okay, sounds good to me. I gave it to you, you store it for me. At any time, I can call you and say I need it back right away. I'll be on the next plane to come get it. No, you can't come see it. We're going to give it back to you in pieces for 7 years. Whoa, what? No, you have my thing. It's in your storage vault. No. We lent it out, and re-lent it out, and triple-lent it out, and quadruple-lent it out to multiple parties so they can put some fires out, paper markets and whatnot, other things. And now they finally got it back. So my question is, why did they get it back so fast? As far as we couldn't give it to them at first at all. 5 tons out of 50 you were supposed to give them. Nope, couldn't make that happen. Oh, let's just pause this for a while. Then somehow we started doing it again. And then all of a sudden, 2017 they got it all back. So we made a purchase somewhere to give it all to them. Why couldn't they wait 3 more years like the plan was? Why wouldn't we, this country, tell them, look, you gave us 7 years, give us 3 more years. Why are they wanting it so urgently? Because I think there's some fireworks to come in the near future, and countries will absolutely be needing their gold in full, in their possession, etc. Just like I tell you, you guys, if it's not in your possession, if you don't hold it, you don't own it. If a country doesn't hold it, they don't own it either, as clearly shown with Germany getting back somebody's gold bars that they got somewhere, but it wasn't the original ones that they stored for safekeeping over here in America. Anyways, back to this story. The commercial short squeeze is leaving central planners little ability to pay back loaned or leased swapped gold at anywhere close to the equitable prices based upon the footprints into February. This February, I stated that there was a potential for price reset in as little as 90 days. Although this window may possibly be extended to the end of the second quarter, the action since my assessment on February 6th has reaffirmed my view, he says. This naturally sparked off some questions, namely that what will happen to futures and options positions in the case of a reset. From time to time, and he's talking about gold, precious metals reset, not talking about, the big reset of the world, just an FYI. And I was pleased to see, as you're going to see in a minute, the stuff I told you back in November 2014, the CME group changed the rules. Circuit breakers now can be triggered for gold. So he covers that. And I told you that there's going to be a reason in the future where they needed that. And it's not because they want the price to go down and save you. It's because the price is going to go up and they're not going to have the control that they used to cap the price, so that circuit breakers will be triggered so that we can't trade and the price will mellow out for a minute until the markets come back on or the circuit breaker time period is over. So this naturally sparked off some questions, namely what will happen to futures and options positions in the case of a reset. From time to time, I share specific members' questions in commentary. This was the specific question I received related to the February 6th commentary regarding the inevitable gold price reset. And it goes like this. If the day before the reset I am long both in the money and out of the money silver calls on the COMEX, and after the reset I have profitable positions, will I be able to sell my silver calls for a profit? It sounds to me that if I am long silver calls on the COMEX, I may be frozen out from doing anything. To answer, that's the question. So the answer, he says, to answer this, we have to look at the bigger picture. We looked in detail at how billions of fractionally anchored, hang on. Got to move this over real quick. To answer this, we have to look at the bigger picture. We looked at in detail at how billions of fractionally anchored offside gold and silver derivative positions had accrued, such as in the OCC report, he says, while a competing physical market has increasingly preyed on the visible price disconnect below supply-demand fair value. It should be noted that the COBASE is currently pointing to a fair value close to $1,350, is anchored upon a 92 to 1 or 92/1 dilutive fractional reserve price. However, real physically derived fair value is unknown, and after 4 decades of synthetic dilution since the gold peg was removed, a true price can only be estimated, but clearly and conservatively, several $100s above the current diluted price. This is not just my view, this is also the consensus of my largest institutional clients who are close enough to sovereign/CB buyers competing for physical below fair value. Liquidity outflows into the physical market has created a fracture between the paper and physical markets, now developing into an abyss caused by strong physical market demand disrupting fractional reserve pricing mechanisms. Other than the slow train wreck of an unthinkable daisy chain too big to fail default, there is only one solution: a paper price reset. I use the word abyss deliberately and draw your attention to the most prominent recorded paper price default evidenced in 1999. This was when Goldman Sachs, or GS, spun out of control after being hung with the auditable recorded 100-to-1 naked short position that LTCM had accrued before they failed. To avert a too-big-to-fail daisy chain BB default, in an emergency move, Goldman Sachs was bailed out by the Bank of England 400-ton physical gold sale known as Brown's Bottom. Shortly after the Bank of England bailed out Goldman Sachs in 1999, Eddie George, governor of the Bank of England, facing a Goldman Sachs bankruptcy, admitted the following. These are his exact words. "We looked into the abyss if the gold price rose further. A further rise would have taken down one or several trading houses, which might have taken down all the rest in their wake. Therefore, at any price, at any cost, the central banks had to quell the gold price, manage it. It was very difficult to get the gold price under control, but we have now succeeded. The U.S. Fed was very active in getting the gold price down, and so was the UK," end quote. Eddie George's career had seen him seconded by the Bank for International Settlements and the IMF. After he retired, sat on the board of N.M. Rothschild. Yes, that Rothschild family. No one was closer to the inner workings of the London gold market. This was a price reset enforced by central planners and officials, and as quoted by Steady Eddie, at any price, at any cost, the central banks had to quell the gold price. Yet here we are again, 100-to-1 short, with physical demand at unprecedented levels, only this time there is zero physical gold to flywheel to dilute supply and get the gold price down. We are witnessing an unprecedented condition because never before has the physical gold price been set outside of officials' control. With liquidity flowing out of the paper markets into the physical exchanges off Loco London, synthetic attempts to swamp supply simply cannot be sufficient duration or scale for central planners to bail out the bank's embedded positions. Much of these BB positions have been accrued at the behest of the Bank of England, the Fed, and the all-controlling BIS, or Bank for International Settlements Trading Desk. As a result, these agent BBs are once more teetering on the edge of the abyss, exposed to billions of dollars of naked short derivatives exposure accrued since 1999, with the spot price ultimately deliverable outside the LBMA casino without physical to meet discounted demand. Selling paper gold below official demand is going to tip these too-big-to-fail banks into the abyss. So here in 2017, and aside from an unthinkable default, this is how a cash settlement will play out. The conduit was already set up in July 2011, where the Dodd-Frank Act blocked U.S. citizens from trading Forex gold on the over-the-counter LBMA market. Not long after, again 2014 I believe was the year, the CME brought in fresh halt trade rules that can freeze COMEX open interest for 5 minutes, options for 3 minutes, while the over-the-counter spot market can trade unaffected. This ensures that any black swan event that spike gold higher during a live session provides a backdoor to LBMA's BBs operating on the COMEX to offset or indeed profit enormously by going long in the over-the-counter markets, while the hot money and U.S. traders are hung out to dry. Given that insiders, the market-making COTs and officials are able to offset short positions off the COMEX as soon as the COMEX reopens, another freeze would be imposed as the price would be halted again. This action would continue into the market close so that a more structured reset can be imposed. Given the hundreds of tons of underwater short positions, offsets on the over-the-counter markets will be massive and will essentially break the market as the price rise on the COMEX and the multiple market halts will exponentially ramp up the over-the-counter bid. Bear in mind, there is a 92-to-1 fractional reserve imbalance, and with the rise in physical prices and the fresh demand, there is no way officials or BBs short thousands of tons, many years annual production, could survive without there also being a cash market reset in London. This is why it is important to have physical gold and physical silver vaulted outside of the Western banking system. The Forex or FX gold market cannot cease to operate, so the reset will benefit insiders who will have placed massive long bets to offset shorts ahead of the reset. Silver will rise with gold in a similar way. So this is interesting to me because of what I just read you 2 paragraphs ago. You, the little guy, can't play. Again, Dodd-Frank blocked U.S. citizens from trading Forex gold into the over-the-counter LBMA market, but it allows the club to play the game so that, like he's saying here, if they're massive short positions, rather than crushing themselves to death, they can play the long side while they still have the shorts. While the circuit breakers are triggered for the rest of us, we can't place any bets. They're going to place bets. Markets rise. They make tons of money over here while losing tons of money over here. Again, offsetting it. But at the same time, they may do more than just offset it. They can make some serious money on the way up. So I didn't know that part, by the way. This is news to me, that little part. That I didn't realize U.S. citizens can't play that game, but the club can. And he puts a good point, reasoning behind why. So this is really interesting for me. So he ends it by saying, silver will rise with gold in a similar way. Well, that's funny because they also put those circuit breakers in for silver too at the same time. The BBs have been delivering gold out of unallocated bullion accounts with a paper guarantee from the Bank for International Settlements that it will settle these BB ledger entries. Given the BIS has direct exposure to the physical market, they will coordinate this event. I see a cash price reset as an already planned event that will avert any embarrassment that a too-big-to-fail taxpayer-supported bank will default. The only orderly way to effect such a reset will be to instigate it over a weekend. We are approaching the point where once more the Fed and BIS is looking into the abyss, and this non-default bailout reset will be triggered. They will simply square these entire paper entries, one market close for cash at the closing price with the stroke of a key. Spot gold holders will be insulated, as it would be virtually impossible to default on a Forex cross, i.e. a short dollar long gold position that trades a part of a $5 trillion a day Forex market. However, all unallocated LBMA gold account holders will be settled with cash on the prior day's pre-gap price rise. To eliminate billions of dollars of derivatives exposure, all derivative positions will be marked to market at the reset point. The COMEX cannot afford to default, but has the option of cash settling positions without it being considered a default. So one of the reasons I said over and over, I've heard people talk about the COMEX defaulting. When the COMEX defaults, I said it is not going to default. The club will never allow something like that to default. They'll shut it down. They'll blame it on a terrorist attack. We can't do something. It will not shut down. You are not going to hear that it defaulted. That will not happen. So the best answer, I think, is what he just said. We, as in they, will just pay out any open contracts in cash. What's the value of it today? Here's your cash money. Your contract is now closed. You're out of the market. And you may say, well, I want back in the market. And you may try to demand delivery. Oh, nope. Can't demand delivery. We're resetting. We're closing the market down. We're paying you out at today's price in cash for that little piece of paper you have. Which I would say, okay, well, when that starts happening, and to save themselves from default, What are these people who want delivery going to do? Even though it's hardly anyone, it's always been hardly anyone who wants delivery. They're going to go find gold. They're now going to understand, if I can't get it that way, I need to go find another way to get the gold. And now I'm going to be in a sheer panic. And now, what was that stupid webbot thing again? What was that? Panic to own gold, especially silver. Panic to own silver. Panic to own silver. I could see where a panic would happen instantly in a scenario like that. So, however, with insider BBs being able to offset COMEX positions in the OTC markets ahead of the reset, it is possible COMEX options and futures may survive the reset. It is the naked short position of hot money short hot money short positions that would be at risk. I would be looking for COT's footprints to be going uncharacteristically long in the over-the-counter market to provide this clue. It is the wholesale market footprints that will give us advance notice of a price reset. I am already seeing the early warning signs. We will shortly be able to offer our clients electronic vault warrants on our ABX platform. This will allow physical holdings to be margined up to 80%. Once these warrants are launched, I see the COMEX as finished. And if the reset has not been triggered before this launch, I see this as the final trigger, as there will be little incentive for traders to trade in the casino. If you wish to open a live ABX Metal Desk platform, here's the link, he says. I'll provide a link to this article for you. There is no immediate requirement to fund it, but this will provide you the conduit to electronically trade wholesale physical when you are ready. For margin traders looking to actively trade zero counterparty risk physical gold and silver outside the U.S. COMEX rigged casino, then preparing the COMEX alternative is a step that could be taken now. It costs nothing to set up the trading platform, and there is no obligation to use it, but it can be ready to utilize. The beneficiaries of this COMEX default, so to speak, will of course be the physical exchanges to which large size institutional liquidity is already flowing. The allocated bullion exchange, or ABX, is a 100% physical exchange and has no skin in the game, so our clients who have segregated vaulted bullion holdings will have access that 100% reflect the resetting physical price. Exchanges such as the Shanghai Gold Exchange will also benefit from a price reset. I will update this timeline within 2 weeks, he says. Now, I realize this was a very long video, but damn it, was it worth it? And if you didn't understand much of what I just read about, I know it's a lot, understand that the whole reason you've been stacking silver, and I have, we've been right all along. This is more proof that we've been right all along. And sometime in the near future, I think it's going to break out. There's going to be all hell breaking loose. It's going to be coming. I don't see another 8 years, from 2000. I don't see that happening. There's no way. Not this time. They've been playing all the cards they can play. They've been playing all the games they can play. Again, they set the rule up for this circuit breakers a few years ago, 2014. That's 3 years ago. And I told you the day they did that, I saw that, I said they're doing this for a reason. They always do it in advance so that when it comes in the future, it's already ready to go. And I'll say it again, they never did that to protect you. They did that to protect the gold and silver price from exploding higher. They had to manage it somehow, and they realized the day would come when they couldn't do what they've been doing to control the price, and that it's going to go much higher. So how do they deal with it? If it goes too high in a certain amount of time during the trading session, circuit breakers are triggered. And then it's going to go crazy again, more circuit breakers are triggered. So that is the only proof. I mean, if I had one story to tell you, and that's the only thing I was allowed to tell you, it would be that the CME group did that, which is forecasting a future event that's going to be very, very good for you and me who hold precious metals. Take care.